Welcome back. The stock on our radar is Inox Wind. It's buzzing in trade. Company eyes to be net debt free with infusion of 900 crore rupees by promoter. Company expects substantial savings in interest expenses going ahead, aiding profitability further. To discuss this and more, we have Devansh Jain, ED, INOXGFL Group, joining us now. Devansh, good afternoon. Thank you so much for joining us. Well, you'll be infusing around 900 crore rupees. The debt as on March stands at 650 crore rupees. So what will the remaining fund be used for, and what kind of interest savings will you see, and what will flow to the bottom line because of that saving?
Hi, good afternoon. Pleasure to be back. Yes, this is a very important milestone for us. We've been working hard on this over the last 2 years. Happy to see that we finally become net debt free. I think in terms of interest cost savings for FY24, our interest costs were about 250 crores. So for this financial year, barring Q1, where obviously we have certain interest costs, we should have overall saving of at least 175 to 200 crores, which will directly go to our bottom line. In terms of term debt, all of these, of course, there are certain timelines within which these need to be paid. We can't prepay some of them, so we are net debt free. But all term debt will be repaid in due course of time. And now what we require is primarily non-fund based facilities, LCs and BGs for our working capital requirements. Even in these, I think we should see a significant reduction in costs and charges, given that our credit ratings have been continuously being upgraded over the past few quarters. And obviously, we believe going forward as well, given all the levers are in place, which is not just a strong balance sheet now. We have a very large order book and very, very strong order inflow visibility. The technological upgrades moving to a 3.3 megawatt turbine, our 4X platform, and actually the very large development pipeline and common infrastructure which we own should lead to us scaling up very, very rapidly.
Right. That's interesting because just a few days ago, there was a brokerage that initiated coverage on your stock, and they factored in close to, 600 crores in terms of net profits next year. And I'm not sure whether they are factoring in any sort of debt repayment out here. So if that were to happen, then in due course of business itself, your net profit would increase over and above the expectations of the analysts by about 150 crores that you've spoken about. Let's talk about your capacity and your orders. You have about 2.7 gigawatts of orders. What's the kind of inflow that you expect, or what's the kind of signings that you expect over the course of this year? And how do you ramp up your capacity? What's your production target for this year and the next couple of years?
Look, so we have a very strong order book of about 2.7 gigawatts already, which is spread across PSUs, IPPs, CNI players, and we see a very, very strong pipeline of orders, which are continuously coming through. I mean, we are participating in many PSU tenders. We are currently negotiating with multiple new customers as well as a couple of existing customers for increasing the already orders placed to us. It's hard to give out specifics at this point in time, but I think given the targets, we publicly guided for 800 megawatts this year, 1,200 megawatts for the next financial year. And typically in the wind industry, your firm order book is about 2 years. So if you look at that, we're already at about 2.7 gigawatts. We're covered for about 2.5 years. Without getting into too many specifics, all I can say is we will look to further upscale our next year's guidance, given the strong order inflows which are expected over the next couple of months.
Okay.
In terms of our manufacturing capacity, it's at about, all in all, with our 3.3 megawatt platform, we can produce about 2.2, 2.5 gigawatts per annum across the nacelles, blades, and towers. So effectively, I think we have a very large manufacturing capacity at this point in time. We may debottleneck, a couple of our blade or tower capacities, looking at some of the demand for equipment supply, which may be coming in the south, but no real capex, which we would like to guide, given that there are multiple sheds available for rent and lease at fairly competitive prices.
Okay. Devansh, if you can quickly tell us, so what will the remaining fund be used for? I believe 650 is the debt. You'll still have some funds left to be used for some other capacity addition or other plans. Inox Green also, there is a preferential issue that you have planned of around 1,000 crore rupees. Will you look at inorganic growth? What are the plans here?
Look, I mean, at Inox Wind, clearly we'll be carrying, now that we've become net debt free or say net cash, we will be carrying some amount of cash at all points in time. From a management perspective, we would like to carry at least 2 months of mandatory payments as net cash at all points in time. Post which I'm sure the board, in its own wisdom, will put out a dividend policy, given we have that in many of our listed companies. In terms of Inox Green, yes, that is a net cash entity, and there has been a fairly large fundraise which has been announced over there. While we've mentioned the primary purpose of raising those funds in the objects, but we've really done that to create a war chest, if I may be blunt and short. We've really done that to create a war chest since we're looking at multiple acquisitions. We've had a very strong set of investors who've participated in the preferential issue, besides the promoters themselves pumping in a substantial amount, given the fairly strong order book that, the fairly strong growth outlook we see for that company as well. And yes, we are working on a couple of acquisition targets at this point in time. These are fairly large O&M plays. Obviously, there's no guarantee that these will go through, but if these were to go through, we would substantially add to our existing fleet and profitability.
All right, we take that point. We leave it at that, Devansh, this time around, but leave it with a promise for you to join us back after your first quarter numbers so that we can talk in detail about growth plans going forward as well, holding his cards close to the chest, but reiterating their guidance that they've made about production as well as sales, and saying that there could be perhaps a bit of an upside to the guidance that they've given itself. Before we slip into a short break, let's